Go to May 2021. Question number 3, part B. If you check now, May 2021, question number 3, part B. So the question is the same. I only want to explain the differences. Mine is on page 32. When you go to page 32, you'll be able to see that question number 3, part B. That question 3, part B is about Bamboo Limited. Bamboo Limited is currently an unlevered farm. Bamboo Limited is currently an unlevered farm. So the farm is expected to generate a constant operating profit, of shillings 20 million per annum, shillings 20 millions per annum. So in perpetuity, the farm's current market value is shillings 80 million. So the management is considering undertaking an expansion activity by use of the debt financing, So the farm's financial analysts have estimated that the present value of any future financial distress cost is shillings 8 million. However, the probability of the distress will increase with the leverage according to the following schedule. It will increase with the leverage according to the following schedule. So value of the debt is given. You see, it is the same as what we had in the other question. Then the difference was only on the probability of the financial distress. So this question is given in form of the probability. Yeah, so in form of the percentage. But the other one, they had already divided by 100. You see the second one, the one for 5.0 million. So the one for 5.5 million, you see they gave you 1.25%. They have given you 1.25%. So for this question to use it, you are to divide by 100. You are to divide it by 100. The other one, they had already divided. So when you divide, you get like what was given in the other question. You see what is given in the other question? It is 0. What? When you check in the other question, you are given 0. Right, just the previous sitting, November 2020. When you check November 2020, it was question 5, isn't it? Yeah, so that figure is 0. What? The second one, the probability of 0.0.12. Yeah, divide this and see that that is the figure that is given. When you divide, you see that is the figure that is given, the second one. So when you are doing this question, you are to divide by 100 before you multiply by the 8 million. But when you check in the other question that we had finished previously, they had given you this. But this one gave you 1.25%. So you are to divide by 100 before you use it. So I hope we are clear at that level, because that's now the first difference. Is it clear for everyone? Because I'm not going to do the question. The question was the same. I'm only explaining the difference between that question and the one that we did. So I hope this one is clear to everyone. Because I'm not going to do the question because the question is the same. I'm only explaining the difference. I'm only explaining the difference. Yeah, so when you get your free time, that is now what you will do. I had already done the question. So the previous question, they gave you this. And you are multiplying it directly. But this one, they gave you 1.25. So when you get 1.25, it is a percentage. Remember to divide by 100 before you use it. So that's now the first difference that we have it on that area. Then when you continue, they say that the corporate tax rate applicable is what? 13%. So required. Roman letter 1 is the same. Roman letter 1 is the same. It has not changed. So what did we get as the cost of equity for the Roman letter 1? Roman letter 1 is the same. We got the cost of equity of, is it 17? It was 17.5. That figure, that answer is still the same. The issue there is, Roman letter 2, it is still the same. Roman letter 2, it is still the same. The way I have explained, the Roman letter 2 is still the same. So remember the value for the levered farm. Value for unlevered, we were adding present value interest tax benefit, then we minus the present value for the bankruptcy cost. So to get that bankruptcy cost, I've explained to you, the question gave you 1.25%. So remember, this is the second one. Remember to divide by 100 to get 0.0125, because the other question they had given me that. So the only difference now, Roman letter 2 and 1 is the same. Roman letter 2 and 1 is what? Is the same, because those figures were remaining the same at that portion. So the only difference now, the only difference is now meant to come in when it comes to what? To Roman letter 3. You see the Roman letter 3, where they were asking you to get the optimal capital structure, the WSEC. So there you are supposed to calculate what? WSEC. So when you are to calculate that WSEC, what you need to do, what we need to do is that we go back to what we did. We go back to the question that we had done. So in the other question, there was the column for equity. There was the column for the debt. So this time around, your part of hammered model is not there. You see, you are not being given the beta factor of equity for unlevered. They did not give you the issue. So hammered model was not able to apply for this question. Even CAPM part was not able to apply for this question. So the next thing you are to do is to calculate KEL. And to get KEL, you already know you have two formulas of getting that. To get KEL, you already have two formulas of getting that. That is now what you are to apply on this question, whereby you remember earnings before interest and tax. You subtract what? Interest, then 1 minus the tax rate. So you are supposed to divide by value of equity. Value of equity. So that is how you are to get KEL. So this is now the difference between now this question and the other question. Then WSEC was not changing. WSEC, where you get the weight of equity, cost of equity for the levered. Then weight for the debt. So KD must always be after the tax. So I'm not doing the entire question. Roman letter 1 and 2 was the same. I'm only explaining now the difference in the Roman letter 3, how you are to apply. Remember, this part will also be given by KEL, will be given by KEU plus in brackets KEU minus KD. And remember D over E, then 1 minus the tax rate. So the only difference now, you are to use either this formula or this formula to get that KEL. But in the previous question, there was a hammered model, there was CAPM to enable you to get KEL. So I hope that's now clear. Yeah. So I'm doing only 2 of them. Then you will continue and see what is there, because we already did that question. We had already done the question yesterday. So I'm only explaining how this question was different from the one you had done in the previous stage. So can you give me the figure that we got as the proportion for the equity from the previous question, because it did not change. The proportion for equity was what? 78.25. How about the debt? 2.5. So this one did not change. These ones did not change. I've said Roman letter 1 remain the same. Roman letter 2, I've explained the difference. Roman letter 2, I've done what? Explain for you the difference. Instead of just that part of the financial distress, you want to divide it by 100. So now we come to this part, KEL. So KEL, we can either use this formula or this, and I'm going to confirm them for you. So starting with this first one, the question had given you earnings before interest and tax. The question had given you earnings before interest and tax. So what was there as the earnings before interest and tax? You remember the 20 million? Yeah, so earnings before interest and tax is 20 million. We subtract interest. So to get the value for the interest, go to the questions. You see the debt is 2.5 million. The pre-tax cost of the debt is 4%. So online, confirm that amount of the interest. You see 2.5 million is the debt. The pre-tax cost of the debt is what percent? 4%. So get 4% of the 2.5 million. That will give us the interest for this debt. So how much will it be? So online, I would like you to participate so that you see how I'm getting the interest, because that's now where the other problem is. So for interest, get 4% of 2.5 million. So I've been given 0.1 million. Yeah, so interest will be 0.1 million. Then now 1 minus the corporate tax, which is 30%. Then divide by value of equity. Value for equity is 78.25. Is this 78.25? It's 78.25. So express it as a percentage. Express it as 17.8. So you are getting 17.8%. Alternatively, you are to use this other one, but for the exam, you are only to apply one of them. I want to show you both so that any of them will be applicable. Alternatively, to get the same figure, we can now use this one. When we use this one, KEU, we calculated. Mnakumbuka at the Roman letter 1. It was 17 point what? Yeah, check 17.5 from the previous question. From the previous question, we had already calculated KEU. So that KEU is 17.5. Then we add also 17.5. Also the 17.5. We also subtract. So KD is the interest rate, which is 4%. You see, when it is 2.5, it is 4%. So you minus 4, then D over E. D over E. So D is 2.5 million. So E is 78.25. Then 1. So I want you to confirm whether this figure is the same as this. But for the exam purposes, when you are doing exam, just use one. And I normally prefer this first one than this second one. So confirm whether this figure is the same as that. Sorry?
17.8.
Yeah, so it is going to give you the same figure. It will give you the same, but so I'm saying you only use one. Don't use both in the exam because there will be no time to prove. So just pick one of them, either this or that. So I'll prefer to apply this first one. It is more simpler than this. Then now it comes to how to get the WSEC. It now comes to how to get the WSEC. So to get the WSEC, they wait for equity. The weight for equity, it is 78.25. Divide by the total. The total was 80. Total. This plus this was just add 78.25 plus 2.5. It is
80.75.
80.75. Then multiplied by what is there as 18.8. Then also add now 2.5. Also divide by 80.75. So KD is given as 4%. KD is what you have as 4%. Then also multiply 0.7. 0.7 is 1 minus 0.3. 0.7 is the same as 1 minus 0.3. So that is now the first one. That is now meant to be the first one. That is now meant to be the first one. So I will do just 2 of them because the question is the same. Then you will finish the remaining part. You will finish the remaining part at your own free time. So this is the first one. That one is the first one. So I want us to go to the second one. The second one is when the debt is 5 million. The second one is when the debt is 5 million. So we go now to the second one when the debt is 5 million. So I want you to confirm when the debt is 5 million. Bring us now to confirm when the debt is 5 million. So when the debt is 5 million, equity is what? Is it 76.4? Yes. So equity is 76.4. So debt there is 5 million. The debt there is 5 million. So now I'm simply using this formula to get KEL. So KEL, earnings before interest and tax, it will remain. It was 20 million. Then to get interest for the second one, you see the debt is 5 million. Pre-tax cost of the debt was given as 6%. Pre-tax cost of the debt was given as 6%. So what is 6% of 5 million? What is 6% of the 5 million? 0.3 million. So this one will be 0.3 millions. Then now 1 minus 0.3. We divide by value of equity is 76.4. Then also express it as percentage. 18.05. Yes. Yeah, so now when it comes to calculating the WSEC, so weight for equity, you simply take 76.4. So total is how much? 80 what? 81.4. So this now will be 5. So KD is the pre-tax cost of the debt, which was given as 6. Then also multiply 0.7 like that. So hiyo ni ya pili. That is now the second one. That is now the second. So we got the third one. I said I'm only doing the 3 of them. Then now you get the format. You will finish the remaining part because the question was the same like the previous question we did yesterday. The only difference was Roman letter 3, and that Roman letter 3, the difference was only how to get KEL. The other one, there was Hamad model, there was CAPM. But now here to get our KEL, we are just to get it from that angle. So what do we have as the proportion for equity for the third one from the previous question? Because the question is the same. 74.55. 74.55. Yeah. Then when that is the case, remember the debt is 7.5. So interest for the third one, it will be 10% of the 7.5 million. You get 10% of the 7.5 million.
0.75 million.
Sorry?
0.75 million.
0.75 million. 0.75 million. Then 1 minus 0.3. We divide by 74.55 million. Express it as a percentage. Yeah, someone is wondering whether the value for equity is calculated now. Unless you have just joined the class, I said Roman letter 1 and Roman letter 2 did not change. The question is the same, like what you did yesterday. The only difference, I've explained all those differences. Yeah, unless you have just joined the class. If you have just joined the class, just seek for clarification. Because what we did yesterday is Roman letter 1 and Roman letter 2. And I explained one of the difference. And the last difference is what you are doing now. So the question was the same. Roman letter 1 did not change. Roman letter 2 did not change. The only difference was on the Roman letter 3. So I hope you get that point. Someone who asked, equity value is calculated now or was calculated yesterday. Yeah, so the question was the same. I've clearly explained the differences. Roman letter 1 did not change. Roman letter 2 did not change. And in the Roman letter 3, the only difference is this part. The only difference is this part. Then WSEC you calculate. So this one is giving us which part? Sorry?
18.08.
18.08. Yeah. So now you compute your WSEC. WSEC weight for equity will be 74.55 divided by the total. That total was which figure?
82.05.
82.05. Now multiplied by 18.08 like that. Then the weight for the debt is 7.5. Also divided by 82.05. So multiplied by, so KD is given as what? 10. You see the 10? Then multiplied by 0.7. Like that. So that is now what we can have at that level. So you will finish the remaining part. You'll finish the remaining part because now I've shown you how the question was different from the previous sitting. I've now shown you how the question was different from the previous sitting. So let us now have a brief subtopics. You will finish the remaining part. I hope it is clear to everyone because I can't redo the entire question up to the end. We still have some more other important things to cover. So is it clear now to everyone to distinguish between the previous question and now this one? Is it okay to everyone as we proceed? Yeah, so you will continue and finish the remaining part. Roman letter 1 is the same as what we did yesterday. Roman letter 2 is the same as what we also did yesterday. The Roman letter 3 I've explained how it is different from the previous. The Roman letter 3 I've explained. So let us have a brief subtopic as MM model. MM model of incorporating personal taxes. We now have a brief subtopic as MM model of incorporating. MM model. So now we look at the MM model. MM model. MM model of incorporating personal taxes. Personal taxes. So we look at the MM model of incorporating personal taxes. So under that, we can summarize that when MM incorporated the personal taxes, when MM incorporated the personal taxes, comma, they concluded that when MM incorporated the personal taxes, comma, they concluded that the net combined earnings of the investor, they concluded that the net combined earnings of the investor, the net combined earnings of the investor will decrease as follows. The net combined earnings of the investor will decrease as follows. The net combined earnings of the investor will decrease as follows. Will decrease as follows. So net combined earnings, the net combined earnings will be equal to the gross combined earnings. Here the gross combined earnings. The gross combined earnings, then 1 minus so to get the net combined earnings, it will be given by the gross combined earnings, then in the brackets of 1 minus the personal tax rate. 1 minus the personal tax rate. 1 minus the personal tax rate. Then a new paragraph, we summarize that in this case, the investor will be equity shareholder. In this case, the investor will be equity shareholder and debenture holders. In this case, the investor will be equity shareholder and the debenture holders. Equity shareholder and the debenture holders. And their benefit is in the form of dividend and interest. And their benefit is in the form of dividend and interest. And their benefit is in the form of interest and dividends. Then another paragraph is that in the absence of the personal taxes, in the absence of the personal taxes, in the absence of the personal taxes, comma, the value of unlevered farm in the absence of the personal taxes, comma, the value of unlevered farm. The value of the unlevered farm will be expressed as follows. The value of unlevered farm will be expressed as follows. Value of unlevered farm is expressed as follows. So this one we already know it. This one we already know it, where we are saying value of unlevered is given by earnings before interest and tax. 1 minus the corporate tax. You are dividing by KEU. You are dividing by KEU. So value for unlevered, if you recall, it was supposed to be given by earnings before interest and tax. 1 minus the corporate tax. We divide by KEU. So that is now how we have been calculating the value for unlevered farm. A new paragraph, we continue by writing that in the presence of the personal taxes, comma, the value of unlevered farm will be expressed as follows. In the presence of the personal taxes, comma, the value of unlevered farm will be expressed as follows. Value of unlevered farm will be expressed as follows. So now, to get the value for unlevered, it is the same as earnings before interest and tax. Then 1 minus the corporate tax. Then also 1 minus. So I'll be explaining what each one of them stands for. So when there is personal taxes and you want to calculate value for unlevered, so value for unlevered will be equal to earnings before interest and tax. Then this one is 1 minus the corporate tax. So this is 1 minus the corporate tax. Then this one is 1 minus, it is personal tax rate on the common stock income. Sasa hii inamaanisha personal tax rate on the common stock income. Common stock is the ordinary shares. So where you say that this one is the corporate tax, so this one is the corporate tax. And this one is the personal tax rate on the common stock income. This is the personal tax rate on the common stock income. So common stock is the ordinary shares. The common stock will be the ordinary shares. Then KEU remain the same. So when you want to calculate value for unlevered, it will be equal to earnings before interest and the tax in the brackets of 1 minus the corporate tax. Then also 1 minus personal tax rate on the common stock income. Then we divide by KEU. We divide by what we mean by KEU. So that is how we shall be calculating the value of unlevered farm. Then another paragraph. So another paragraph, we write that in the absence of the personal taxes, comma, the value of the levered farm will be expressed as follows. In the absence of the personal taxes, comma, the value of the levered farm will be expressed as follows. Value of the levered farm will be expressed as follows. Value of the levered farm will be expressed as follows. So value for the levered farm is supposed to be given by value for unlevered, then we add present value interest tax benefit. So to get the value for the levered, it is equal to value for unlevered, then we add present value interest tax benefit. Then we add the present value interest tax benefit. So this is when there is no personal taxes, in the absence of the personal taxes. That's how we were calculating the value for them and delivered. Now a new paragraph, we write that incorporating the personal taxes, comma, the value of the delivered farm will be expressed as follows. Incorporating the personal taxes, comma, the value of the delivered farm will be expressed as follows. Value of the delivered farm will be expressed as follows. So now to get the value for the delivered, it will be equal to value for undelivered. Then we add that multiplied by the tax advantage of the debt, the tax advantage. So we just come up with a tax advantage of the debt. So when you want to compute value for the delivered, simply get the value for undelivered, then we add in brackets the debt multiplied by the tax advantage of what? The debt, the tax advantage of the debt. So this is the same as value for undelivered, so it will be plus. So this is now the debt. So the tax advantage of the debt is given by 1 minus I want to explain what each one of them stands for. So now to get the value for the delivered, it is value for undelivered, then debt is the same. But now this part of the tax advantage for the debt. Tax advantage for the debt is given by 1 minus. So here in 1 minus the corporate tax. This other one is 1 minus the personal tax rate on the common stock income. This one is the personal tax rate on the common stock income. Then we divide by 1 minus. This is the personal tax rate on the debt income. So this denominator is the personal tax rate on the debt income. The personal tax rate on the debt income. So that is now how we shall be calculating it. So tax advantage for the debt is given by this part. 1 minus, this is 1 minus the corporate tax. This is 1 minus personal tax rate on the common stock income. Divided by 1 minus the personal tax rate on the debt income. Then you come up with that value. So I will use a question. So we can use a question. So go to December 2010, question number 5, part B. We go to December 2010. There is a question number 5, part B. December 2010, question number 5, part B. Go to December 2010. There is a question number 5, part B. So mine is on page 112. When you go to page 112, you'll now be able to see that question for December 2010, question number 5, part B. Question 5, part B. Yeah, mine is on page 112. I hope everyone could see that question. Are we able to see it? Yeah, tumeiona. Yes, so I want us now to go through the question. Question 3, question 5, part B. So that question 5, part B, it was reading that MM Limited has earnings before interest and tax of shillings 3 million. Earnings before interest and tax of shillings 3 million. And 40% tax rate. And the 40% tax rate. It is required rate of return on equity in the absence of borrowing is 18%. It is required rate of return on equity in the absence of borrowing is 18%. So required in the absence of the personal taxes. In the absence of the personal taxes, determine in the absence of the personal taxes, determine the value of the company in the Modigliani and the Miller, in the Modigliani and the Miller world. Roma letter 1 with no leverage. Roma letter 2 with shillings 4 million in debt. Roma letter 3 with 7 million in what? In debt. Then when it comes to part C, they were saying that with the reference to part B above, assume that personal as well as corporate taxes now exist. Personal as well as the corporate taxes now exist. The marginal personal tax rate on the common stock income is 25%. And the marginal personal tax rate on the debt income is what? 13%. So determine the value of the company for each of the 3 debt alternatives in part B, Roma letter 1 and 2, 3 above. Comment on your answer. So we start with the part B. Part B is the normal M&M model. So that one is without personal taxes. So Roman letter 1 of the part B. Roman letter 1 of the part B. The Roman letter 1 of the part B is with no leverage. With no leverage. So when it is with no leverage, it means it is unlevered. With no leverage, it means unlevered farm. This is the same as unlevered farm. That is the same as unlevered farm. When no leverage is the same as the proportion for the debt. So value of unlevered farm is given by earnings before interest and tax. 1 minus the corporate tax divided by KEU. So earnings before interest and tax was given. Earnings before interest and tax was given. The figure was 3 million. The value is 3 million. 1 minus the corporate tax. 1 minus the corporate tax. So corporate tax was 40%. So 40% is the same as 0.4. So KEU has also been given. KEU has also been given. The cost of equity for unlevered farm. You see, they have said that it is required rate of return on equity in the absence of borrowing is 18%. So 18% is the same as 0.1. So that now will give you value for unlevered with no leverage. To give us 10 million. 10 million. So we go to the Roman letter 2 with shillings 4 million in debt. So Roman letter 2 is meant to be with shillings 4 million. 4 million in debt. 4 million in debt. With shillings 4 million in debt. So value for the levered is supposed to be given by the value for unlevered, then present value interest tax benefits. So now it is levered. This part is levered farm. Levered farm. So value for unlevered, you already have it. It is 10 million. Then we now add present value interest tax benefit. Simply take the debt, which is 4 million, multiplied by the corporate tax, which is 40%, multiplied by the corporate tax, which was given as 14%. So simply take the 4 million. This part is supposed to be given by the debt, multiplied by the tax rate. So the debt is 4 million. The corporate tax is 14%. So 40% is the same as 0.4. So that is now, for that set is how much?
11.6.
11.6 million. So 11.6 million. So you go to the Roman letter 3. So Roman letter 3 is with 7 million. 7 million. So this one is also levered farm. This one is also levered farm. So value for the levered farm will be given by value for unlevered. Then you also have present value interest tax benefit. So this one will be 10 millions, then plus. So that will be 7 million. So how much is that?
12.8 million.
12.8 million. You are all getting that figure? Are we all at that same place? So now let us go to part C. Let us now go to part C. We now go to part C. So part C is with reference to part B above, assume that personal as well as now corporate taxes exist. Marginal personal tax rate on the common stock income is 25%. And the marginal personal tax rate on the debt income is what percent? 30%. So we repeat the same, the entire process, but now there is what? Personal taxes. Both corporate and personal taxes now do what? Exist. So let us start with the Roman letter 1. We are repeating what we have just done. But now there is what? Corporate and personal taxes. Now there is corporate and the personal taxes. Now there is the corporate and the personal taxes. Now there is the corporate and the personal taxes. So we start the Roman letter 1 with the no leverage. Roman letter 1 is with no leverage. Roman letter 1 is with the no leverage. So with the no leverage, so the firm is unlevered. So unlevered firm with no leverage, the firm is unlevered. So value for unlevered firm, it is supposed to be given by earnings before interest and tax. 1 minus the corporate tax. 1 minus the corporate tax. 1 minus the personal tax rate on the common stock income. Then we divide by KEU. We divide by KEU. So earnings before interest and tax is given as 3 minutes. It is given as 3. So 1 minus the corporate tax. Corporate tax was 40%, 0.4. Then 1 minus personal tax rate on the common stock income. Personal tax rate on the common stock income. What are you given in part C? What is there as the marginal personal tax rate on the common stock income? 25%, which is the same as 0.25. We divide by KEU. KEU, you remember in part B, 18%. 18% was the same as 0.18. So that one is not changing. 0.18. So that now will give you within our leverage.
Second,
7.5. So we go down to the Roman letter 2. We go to the Roman letter 2. We go to the Roman letter 2. Roman letter 2 is with shillings 4 million in debt. So now the farm is levered. So value for the levered is supposed to be given by value for unlevered. Then remember this part. How we pay it in that manner. So value for the unlevered, you need to make a calculator for it. Yeah, so you get. So now the value for the debt, it is 4 million. Can you check now in the question? In that Roman letter, part C, what are we given as marginal personal tax rate or the debt income? 30%. So 30% is the same as 0.3. So you can have it now like that. $8.9. Online, you are getting which figure? 8.93. So that is now your Roman letter 2. Roman letter 3 is the same. You only change the value for the debt to 7 million. So when it comes to the Roman letter 3, it is the same thing. Change this one to 7 million. Everything remains. It is only this part of the debt, which will be 7 million. So repeat the entire process for the Roman letter 3. You only change the value for the debt into 7 million and get the value for that. So, we wanted you to comment. When we compare the two, when you compare part B and now part C, where is the value higher? We did part B without personal taxes. Part C is with the personal taxes. So when you compare the two, where is the value higher? With the personal or without the personal? Yeah, so this one, the values are lower than what we have calculated before, isn't it? Yeah. So I hope online you can see that, because they also wanted you to comment. They also wanted you to comment. So you can now comment by writing that. We can now comment by writing that the presence of the personal taxes, would reduce the value of the farm. The presence of the personal taxes would reduce the value of the farm. Would reduce the value of the farm. The presence of the personal taxes will reduce the value of the farm. Will reduce the value of the farm. So that's now on that item. So there is one part remaining on the M and the N before we conclude that chapter. There is something that still remains before we conclude that. So I want us now to have a brief subtopic as MM proposition. MM proposition on the dividends. So we can have a brief subtopic as MM proposition on the dividends irrelevance model. On the dividend irrelevance model. So we now go to a subtopic as MM proposition on the dividends irrelevance model. On the dividends irrelevance model. MM proposition on the dividends irrelevance model. On the dividends irrelevance model. MM proposition on the dividends relevance model. So under that, we shall first write that this is a model which explains. It is a model which explains. It is a model which explains that payment or non-payment of dividends. It is a model which explains that payment or non-payment of dividends, payment or non-payment of dividends will not affect the value of the farm. So it's a model which explains that payment or non-payment of dividends will not affect the value of the farm. It will not affect the value of the farm. It will not affect the value of the farm. And it operates under the following assumptions. It will not affect the value of the farm, and it operates under the following assumptions. And it operates under the following assumptions. So number one is that there is no transaction costs. Number one is that there is no transaction costs associated with the flotation of the shares. There is no transaction costs associated with the flotation of the shares. There is no transaction costs associated with the flotation of the shares. Then number two is that there is no personal and corporate taxes on the dividends. There is no personal and corporate taxes on the dividends. There is no personal and corporate taxes on the dividends. There is no personal and corporate taxes on the dividends. Then number three is that the capital markets are perfect and efficient. the capital markets are perfect and efficient. The capital markets are perfect and efficient. Then number 4 is that the farm investment policy is independent of the dividend policy. The farm investment policy is independent of the dividend policy. It is independent of its dividend policy. It is independent of its dividend policy. So we are writing that the farm investment policy is independent of its dividend policy. It is independent of its dividend policy. So that is now what we have for that. So there's a question for December 2021. I want you to go to December 2021. December 2021. December 2021. That the real exam, not the pilot paper. Mine's on page 21. Go to page 21, you'll be able to see that. December 2021, there is a question number 1, starting with part A, then part B. Starting with part A, then part B. So that question reads that question. So you can see part A, December 2021 question. There is 2 December 2021, the pilot and the real exam. So this one is the real exam, where part A, they say that summarize 4 assumptions of Modigliani and Miller hypothesis. They wanted you to summarize 4 assumptions of M and M hypothesis. So those assumptions are the one I've given you because of the part B, because part B now is what will lead you to what we have just written. So when it comes to part B, they are saying that SAC Limited has a cost of equity of 40%. 20%, sorry, 10, so yeah, 20%. The company currently has in issue 500,000 shares outstanding and selling on the securities exchange at 200 shillings each. The firm's earnings at the end of the current year is estimated at 15 shillings, and it intends to maintain constant dividend payout ratio of 60%. So the company's expected net income is 6 million. The company's expected net income is 6 million, and available investment proposals are estimated to require shillings 12 million. So required using MM proposition on the dividend irrelevance, show that payment or non-payment of dividends does not affect the current value of the firm. They would like you to show that payment or non-payment of dividends does not affect the current value of the firm. So we want to prove that whether you pay dividend or you don't pay dividend in your company, there will be no changes in the value of the firm. So what I will do, I will first confirm the value for the firm. The first thing is to get value of the firm. So value of the firm in this case will be NPO. So now the value of the firm will be equal to NPO. So where N is the existing number of the ordinary shares, where N is simply existing number of the ordinary shares. Then PO is the current market price. PO refers to the current market price. So now going by that, if you check through the question, you see they say that the company currently has how many in issue ordinary shares outstanding? So N is given as 500,000 shares. Are you able to see the 500,000 shares? N is given as 500,000 shares outstanding and selling at the securities exchange at how much each? 200 multiplied by 200 shillings each. So when you do that, that now will be able to give you value of the firm. It will now be able to give you what is supposed to be the value of the farm. So how much will it give us? So this one will be 100 million. To be 100 million. So that value will remain the same, whether you pay dividend or you don't pay dividends. So let us now start with if no dividend is paid. If no dividend is paid. If no dividend is paid. You want now to check if no dividend is paid, what should be the value for the farm? So if no dividend is paid, it means D1 is equal to 0. If no dividend is paid, it means D1 is equal to 0. Then maybe you can just say that D1 is the dividend per share at the end of the year, where D1 is the dividend per share at the end of the year, where D1 is the dividend per share at the end of the year. D1 is the dividend per share at the end of the year. So there are 3 steps we shall follow to confirm that if no dividend is paid, the value will still be how much? 100 million. We are simply confirming that if no dividend is paid, what should be the value for the farm? You need 100 million or 10 million. Is that figure 10 million or 100 million? 100. Online in on 10 million, 10 million. Is that the figure? It's 100 million. So there are 3 steps. I want us to confirm that if no dividend is paid, the value still remains what? 100. So we have 3 steps. We start the step number 1, where we say that estimate P1. So our first step is to estimate P1. Our first step will be that estimate P1. Where P1, maybe you can write that, where P1 is the price per share at the end of the year. Where P1 is the price per share at the end of the year. Where P1 is the price per share at the end of the year. So to do that, I will use this formula that PO is equal to D1 plus P1 divided by 1 plus R. So we want to estimate P1, but to get P1, we use the formula that PO should be equal to D1 plus P1 divided by 1 plus what? R. So PO is this figure, the current market price. D1 is this one. We have said it is the dividend per share at the end of the year. P1, we are looking for it, the price per share at the end of the year. And R is the cost of equity or the cost of capital. So that R is the cost of equity. So we come down here where there is PO, we put there 200. So D1, we know it is 0. We are looking for P1 like that. Divide by 1 plus R. So R is the cost of capital. R is the cost of equity. So from the question, what are you given as the cost of equity?
Is it 200 or 100?
Sorry?
Is 0. Is it 200 or 100 minutes?
Who you? We are dealing with PO. Yes. So PO is this one here, the 200. Yeah. So our R, what is R in the question? The cost of equity. 20%. 20% is the same as 0.2. So make P1 to be the subject. Make P1 to be the subject and see what value do you come up with at that level. Sorry? 240. So online, yeah, they have given me 240. So that is now our step number one. That is now our step number one. I hope everyone else is getting 240. So that is our step one. We got the step number two. We got the step number two, where we say that estimate M. So after the step number one, we got the step number two, where we say that estimate M. We now estimate M. We estimate M, where M, maybe you can comment that, where M is the number of the new shares to be issued to raise new capital, where M is the number of the new shares to be issued to raise the new capital, where M is the number of the new shares to be issued to raise the new capital. M is the number of the new shares to be issued to raise the new capital. So to deal with that, I will use this formula. I will use this formula where we say that MP1 will be equal to I minus X plus N P1, like that. So I did not go into detail because I'm just showing you how to deal with them in the purpose for the exam. But there is a way I can prove everything for you by writing them, which will be a lot of time. So I just want to confirm for you how to simplify to see the model. So we want to estimate M. M, I've said that it is the number of the new shares to be issued in order to do what? To raise the new capital. So we use this formula, MP1. So M is this. P1, you calculate. So where then is Jawambia, this one is investment opportunities, where this I is investment opportunities. I is the investment opportunities. Then this X is the net income. X is the net income. Hii ingine mnajua, so huyu N huyo. This N is this one. Huyu D1 ndio tunakubaliana nini? Zero. So the rest of the details you know. The only new item there is I. I is investment. X is the net income. N is this one. D1 is that. So I want you to go back to the question. I want you to go back to the question. So when you check through the question, what are we given as expected available investment proposals are estimated to require how much? You can see the 12 million. That is our I investment. Then X is the net income. The company's expected net income is how much? 6 million. So it will be 12 million minus 6 million, then ND1. So N is this number of ordinary shares. You see N, they are existing number of the ordinary, which are 500,000, isn't it? So 500,000 is the same as 0.5 million. But we have said that where D1 is equal to what? 0, because there is no dividend that is paid, so D1 is equal to 0. So when you complete, this one should give us which value? Inatupea 6 million, isn't it? Yeah, so my concern is to calculate PUM. So where M now will be M, P1 divided by P1, like that. Because we want to get M. Once we get MP1, to get M, simply get MP1 divided by P1. And we have said that MP1 is what? 6 million. Then huyu P1 is what you got here. You say it's 240. Yeah, it was 240. P1 is this one here. Is 240 by that. So get that value. It is 0.025 million, isn't it? Yeah, so now after that, we got the step number 3. We have so far gone through two steps, estimating P1 and estimating what? M. So the last step is now to estimate the value of the farm. So I got the step number 3. So step 3 is now estimate the value of the farm. Estimate value of the farm. So to estimate the value for the farm, we want to see now how to calculate the value of the farm. So that value of the farm, it is going to be given by P1, then N plus M minus I, then plus X, divided by 1 plus R. So now we are estimating the value of the farm. To get now the value for the farm, it is P1 in the brackets of N plus M minus I plus X divided by 1 plus R. So we want to see whether we shall get this same figure of 100 million. So P1 is already completed. You can see our P1. It is 240. P1 is 240. So N is existing number of ordinary shares. Is equal 500,000. So they are meant to be 500,000. So we add M. M ndio. So these are 250,000 shares. How much 25,000? There are 25,000 shares. It's like that. Yeah. 25,000 shares. Then we minus. So mnakumbuka huyu ni nani? Investment. It is 12 million. So I want us to write them in full. Then we also add. This one is net income. So mnakumbuka the net income. How much? 6 million. So add the 6 million. Then now divide by 1 plus R. R was 20%, isn't it? So 20% is the same as 0.2. So now I want you to confirm this figure, whether it is 100 million. Get for me that value to know whether it is 100 millions. $100 million. So it will remain the same. It is remaining the same. It is remaining the same. So now I want us to check if dividend is paid. What we have done is if no dividend is paid, this value is still 100 million. So let us now check, repeat the same if dividend is paid. I want us now to repeat the same if dividend is paid. I want us now to repeat the same if dividend is paid. We can now repeat the same if dividend is paid. If dividend is paid. What we have done is if no dividend is paid. So if dividend is paid, First, compute the dividend per share, because the question gave you earning per share and dividend payout ratio. So to get the dividend per share, simply get earning per share multiplied by dividend payout ratio. Dividend payout ratio. So if dividend is paid, to get the dividend per share, get the earning per share multiplied by the dividend payout ratio. Multiplied by the dividend payout ratio. So earning per share is given in the question. Earning per share, the firm's earning per share at the end of the current year is estimated at 15. So it is 15. So dividend payout ratio was given as 60%. So the firm will maintain a constant dividend payout ratio of 60%. So get 60% of that. We get 60% of that. Hiyo inakuja nini? 9. So this 9 is our D1. So D1 is now 9. So we start the step number 1. So step 1, we say estimate what? Remember our step 1, estimate P1. We now start afresh. The first step, we estimate P1. So to get P1, I've given you the formula that PO should be equal to D1 plus P1 divided by 1 plus R. So our PO, we already know. So tunakumbuka our PO from this part, it was 200. So our PO was meant to be 200. Then D1 is 9. We are looking for P1. Then 1 plus 0.2. 1 plus 0. So can you confirm for me, what is that figure of P1 when you make P1 to be the subject? Someone online has given me 231. So I've seen 231. Anyone else? Yeah, I'm seeing 231. So that's now our step number 1. We got the step number 2. Step 2, we said we estimate M. The step number 2, remember we said we estimate M. To get the value for M, we say that M P1 should be equal to I minus X, then plus N P1 like that. So M P1 will be equal to I minus X plus N D1. So I, we already know, was it 12? Was it 12 million? X was 6 million. Then N is 0.5 million. This number of the ordinary, so 0.5 million. So D1, we have said is 9, isn't it? D1 is 9. So confirm for me, what is MP1? Confirm for me, what is MP1? So MP1 will give us which here? 10.5. So this one is 10.5. So now to get M, it is MP1 divided by P1 like that. So it will be 10.5 million divided by so P1 tunasema 231. Yeah, so I want you to confirm if it has so many decimal places, we normally leave it the way it is. If it has so many decimal places, we normally leave it the way it is. So, does it have so many decimal places? It is like what? Yeah, so remember, if it has so many decimal places, don't round off, just leave it, because you want to use it in the step number 3, how to get the value for the farmer. So now after that, go to the last step, number 3. So because this one, I'm told it has so many decimal points. So when it has so many decimal points, you can just leave it, but it is not rounded off. Yeah, I've been told it is 0.0454545, isn't it? Yeah, so when it has so many decimal points, you can just leave it the way it is. You use it directly the way it is in the next part of the model. So now we got the step number 3, where we estimate the value of the farm. We now got the step number 3, where now we estimate the value for the farm. So step 3, estimate value of the farm. So to get the value for the farm, remember I've given the formula of P1. I've given the formula of P1 in the brackets of N plus M minus I plus what? X divided by 1 plus R. Unakumbuka this formula? Yeah, in your model, but I don't want to go into detail to formulate it because our time is limited on that. So P1 is 231. Then N was 500,000 shares. So UM, I've said, is the same as this divided by that. But you can still use what you had. Yeah. You can still use what you had calculated. So if you use the one that you calculated, when you multiply by 1 million, it will be 454. So it is 454, 545, isn't it? 545 like that. Then subtract. I is 12 million. Then add. X is 6 million. This is 6 million. Then divide by 1 plus R. So R is 0.2. So confirm what value are we coming up to. So you are getting which here? Read the same. Yeah, we must also get 100 million. So that's now the confirmation. Remember the question was asking you using M and M proposition on the dividend ratio that payment or non-payment of dividend does not affect the current value for the farm. Current value for the farm, you got to calculate. Tunaona. Tukapata how much? 100 million. Repeat the same when no dividend is paid. You remember we also got 100 million. Now we have also repeated the same when the dividend is paid. We are still getting what? 100 million. So that's now the confirmation. Therefore, we can now conclude that. Therefore, payment or non-payment of dividends, therefore, payment or non-payment of the dividends will not affect the value of the firm. Therefore, payment or non-payment of the dividends will not affect the value of the firm. Therefore, payment or non-payment of the dividends will not affect the value for the firm. So that's now the conclusion you are meant to make. So we have now finished that part of the topic. We are supposed to start on the mergers and acquisition. Sijui kama kuna notes mlipata kwa mergers and acquisition. Yeah, so I'm meeting you people on Sunday. Sasa sijui kama this time bado mnachukua hiyo time ingine. Last time, the time was taken up. Is there any other class mmepanga on Sunday? I want a confirmation from you guys because we need to have a class. UFR inaishanga saa ngapi? Around? Yeah, sasa mpushe FR ianze mapema because kama mnafanya all the papers, you will only pass when you have passed all the papers, FR and advanced FM. So you need to balance off. Yeah, you are doing 3 papers, I suspect. One of the paper is advanced financial management. The other paper is advanced financial reporting. And your certificate will only be complete when you pass the 3 papers. So we should not only put all our efforts on one paper, you forget another paper. Because last time niliwaachia mkafanya FR. Then you have been doing it. So, FR mjaribu away muongee na mwalimu amalize by 9. Yes, so that I come in either 9:30, here you get the benefit of, because I want to finish. So we agree on that. Yeah. Is it clear? So I will come in exactly at 9:30. Or let me make it 10 so that everybody is available. So let us make it exactly at 10. So we start at exactly 10 for at least 2 or 3 hours. So that one is agreed, isn't it? Yeah, so the notes for mergers and acquisition are shared. I will also share for you restructuring and reorganization so that by next week we should be done with the mergers and acquisition and restructuring so that hilo wiki ingine, because I suspect you still have 2 more other weeks remaining after this. Yeah. So I'll share the notes for the theory on the group. Then I will do my part to clear the computation part so that the theory is not standardized. We can just answer from the general knowledge. Lakini this one you cannot have the general knowledge. So let us meet on Sunday from 10 so that we do the mergers and acquisition. So that we do the mergers and acquisition. So we can stop there for now.